Hey guys, welcome back to the Capital Mindset Show. We're going to be doing the second stock today. And again, if you guys already seen the Shopify video, this is again just right after it. We're going into Best Buy. All right. So Best Buy is a large box retailer. I'm assuming most of you in the United States, at least, are very familiar with Best Buy. You have different variations of this type of business globally. So depending on what country you're in, you have something that sells consumer electronics primarily, but also appliances and the like, right? And so, we in the United States, we used to have something called Circuit City that no longer exists, for those of you who are old enough to even remember that. But Best Buy as a business, right, has kind of expanded into what's been left behind and has been doing a decent job, if not a great job, at adapting to the new modern world. Okay. Now I'll say this right off the bat, right? When I think of buying, for example, a TV, I think of Walmart, Amazon, and Best Buy. That's what just comes to mind, right? I don't really think of Target personally. My wife does. If you ask my wife, she'll go to Target over everything. So that has something to be said. So depending on, I guess, the demographic that we're specifically talking about, the different business comes to mind as far as what can service what need, right? So for me, Best Buy is definitely on that list. I think of appliances. Again, I actually think of first, I think Best Buy. I don't even think of Amazon. And then I think of Walmart after that. Okay. And then obviously Home Depot, Lowe's, I think of other things, right? But specifically talking about these kinds of things, that's what I think of. Best Buy. I also actually might consider Target for other things, by the way. But again, focusing simply on Best Buy, I think of those things, right? So when we get to the investor presentation, or actually let's begin with the stock price, how that's performed. What are my thoughts, if anything? And I think it's going to be pretty vanilla, but it's done really well relative to the market in the past 5 years. And we see that it had this massive jump up back in November 2019. And then, since then we've corrected. Looking at the very long term, it's done very well, actually. It's done extremely well if you look at that from that perspective. Now, currently on a GAAP basis, it looks pretty cheap. Google says it's really cheap, implying a 3.58% dividend yield. So again, these returns are not taking into account dividends reinvested. Had you reinvested the dividends, you probably did even better. But we'll kind of discuss a little bit about whether or not they should be paying a dividend right now when we get to the model. But that's a little bit here, neither here or there. All right, that's like lowest end of importance. All right, let's take a look at the investor presentation, and we're going to just skim through this because this is the sales pitch. This is the management saying this is why you should invest in us. All right, so they delivered record revenue and profitability. Okay, that's great. Piloted multiple store formats. Okay, that's great. Adaptability, because with the changing consumer market comes changing consumer needs, desires, psychology. So you want to cater your business obviously to the changing consumer trends, and that kind of comes with making sure the layout of a store is different, right? Layout is very, very important. Every position of every thing is supposed to be strategically placed so that you increase the probability that a consumer leaves the store with a purchase, right? But not only that, they also have launched the new membership program, right? So consumer loyalty and stuff like that. And the expertly managed supply chain challenges, of course, is extremely important, because if I go to your store and I don't find what I need, I'm going to go to your competitor, and your competitor is more likely to have me as a recurring customer, because I'm going to remember that time you didn't have something. And I'm going to remember the time that, I don't know, Walmart had that same thing. And I'm going to say, well, Walmart, maybe it's worth the drive, because I don't want to go to the store and find that they don't actually have it, right? Same thing with their online business. It's a really bad thing if you have supply chain problems as a retail store, because at the end of the day, what you are is a congregation of items, right? That's what you are at the end of the day. I am the consumer. I go to you because you are a congregation of items. Like, think of the ancient world's grand bazaars, marketplaces, the forums, right? These are the places where you go to buy goods and services that you are looking for. And it's a place where it's all congregated. Best Buy, Walmart, Amazon, these are places where these things are congregated, right? Okay, so taking a look at the financial results, we see 10% growth, decent growth, but not as much as obviously some competitors. Basis points expansion, right? So basically what that means is they grew by 1.1%, right? In simple terms, so 110 basis points. And that's good, all well and good. When we get to the law of large numbers, that's actually really good because they are working with a decent size. Now, this is very important. So at the stage of the business that they're at, and we'll actually judge them on this, share repurchases of $4.2 billion with on top of the dividend, right? So they are returning a decent amount of cash to shareholders. And that I think based on the size, and let's actually revisit this so we can kind of get an idea, the size is 24 billion. So a $4.2 billion buyback and dividend is a very good yield return, right? And that 4.2 is, if I accidentally said that, it's both dividend and buyback, just to be clear, for those of you who are audio only, right, or just listening to me. So they spent $1.2 billion. Okay. So this is important because we need, or this is more like their branding though, but they need to position themselves in a way that's favorable to the consumer. Culture is important. Culture drives, a bunch of things. And if the culture today cares about these things, then, this is something that is a good investment longer term, right? Whether or not people actually care about these things is a different story and a different question entirely. So these are really important. Cool. Let's see this. Okay. So enterprise revenue. So we see that for full year 2022, we see that revenues are coming down a bit, but still higher than 2020. So this is, well, this next part's kind of a little bit negative. Domestic comparable sales is negative 2.1%. International comparable sales is negative 3.8%. This is not necessarily a bad thing because we are going off of a really high base. So we have to understand that context matters, but etc. All right. So appliance, virtual reality, home theater, and headphones. These are the things that were growing. And then what was not doing so good was gaming, mobile phones, tablets, and services, right? So these were not doing so well. So, but again, we're going off of a really high base. Okay. So gross profit margins. Okay. So this is important. We see a small decline, right? Small decline. Again, we're going off of a high base, so I can't really fault them too much for that. But gross profit margins of 20% around there is pretty good for a retailer. I'll just say that it's nothing too shabby. And then one thing I want to state here is they are spending more on sales and marketing, right? SG&A. Okay, so one thing that they are seeing here is advertisement went up, technology. I think that part is very important. Store and call center labor. So they are expanding, right? Where does that come from? That comes from e-commerce, right? Because you want to increase the availability for people to talk to someone and say, oh, I have a problem. My order didn't come through. Those are all infrastructure spending. And then Best Buy Health, I'm assuming that is like their healthcare plans for their employees to attract talent, because we all know that there's a talent crunch right now. Okay. So you need to offer a little bit more for people to want to work there. This is the breakdown. Perfect. This is what I really wanted to see. Full year 2022 financial outlook. They're going to do share repurchases of 1.5 billion. Remember, they're a $24 billion market cap company. So that's a decent chunk. Okay. That's nothing to scoff at. And if the shares come down in price, that 1.5 billion will go even further. So let's hope for that for the sake of the long-term outlook of this business. And if you are invested in it personally and you're looking to hold this out for about 10 years plus, I really hope, for example, the best thing for you would be to somehow the shares come down so much that the whole market cap is like close to that, and you're the last one standing. Imagine that. You just own all of that. That's not a possibility, by the way. There are a lot of that would be a fun scenario. That would be hilarious. That ever were to happen in a publicly traded company. All right. Anyway, the side note, I like to have some fun sometimes. All right. So the path forward. All right. So this is their outlook, what they're going to do, purpose, enrich life through technology. Okay. A lot of buzzwords. Look at me. I'm so amazing at tech. Non-operating GAAP, operating income. Okay. So that's important, I guess, for our targets though. I want to see if they had a growth percentage. Our business has dramatically evolved. Yeah. Cool. Okay. Online sales as a percentage of revenue. So 34%. Wow. That's actually a decent amount. Good on Best Buy. I mean, I remember I bought something in 2020 for sure. I think it was a laptop. But I used Best Buy because they actually had the best price, and they do price match, by the way. You guys should actually price shop, it actually works out. If you do that, let them compete. This is good for you, the consumer. Let them compete for your business. has been stable over time. All right, so I think we're gonna hop over to the model. All right, let's go to the model. So yeah, we're coming off of Shopify. Let's go to BBY and let's wait for it to load. So current price is that it might have already loaded. All right, so I'll let you guys pause here, take a look at that. If you guys are interested in that kind of stuff. All right, now we're back here. So obviously Best Buy is not growing at these rates, just so we're all very clear. So let's remove this one, remove this one, remove this one, remove this one, and let's make 10% like the high end that they grow at above average rate of return going forward into the future. Let's bring this down to a 10%. We're going to switch this over to a 2% buyback instead. And because I don't want to assume the full buyback, but like, let's say they slow that down, and we'll actually come down here to kind of get an idea of what the heck is going on. So return on assets is good. It's decent. Return on equity is very good, right? But we'll actually take a quick look at some other factors that are a little bit more important. They are actually a bit equity heavy, which is actually really interesting, I guess, because they're not actually using that much debt, and we have to consider share-based compensation, and it's taking that into account. But they're a net negative issuer of stock because they are spending a lot on buybacks. Okay, so let's actually pencil out these growth rates real quick. So 7% is one. And you can see here, market average rate of return, it's implicitly a very good bargain. Okay. All right. So taking a little bit look back at here, I want to actually, well, let's actually finish this. But I want to actually talk about the return on invested capital. Return on invested capital is absolutely fantastic. This is going off of, again, a higher base. So if we'll take a look at the ratios to see how it normalizes. But essentially what I want to, pivot to or discuss a little bit in greater detail is the, should they be giving us a dividend and doing buybacks? Well, with that high return on invested capital, I'd actually question that narrative. I would say that they should not grow the dividend too much. Obviously, well, let me be very frank. The management has a clearer picture as to what it is, the projects that they could invest in. So if management is giving us all these returns of capital, perhaps they're saying that there isn't really many projects to invest in. And if they invested in more projects, right, then that ROIC won't actually be that high, right? But again, we'll look at the previous ROICs to kind of get a comparison, because it is really high, perhaps because of what's been going on and the environment we just are now leaving, right? So that's a little bit of the added nuance. Okay, I just want to clarify. All right. So, but again, let's take a look at these growth rates, and let's actually finish off with some decays. So -5% and then -10%. All right, so this will hopefully give us an idea of how cheap Best Buy really is at these discount rates, which I think 10% is not appropriate right now. I think, for example, we need a bit of a margin of safety for something like this at the present moment. And again, remember, 10% is double what they normally would go for. 5% is 5.6% is what it's been averaging out. And then you can still assume some decay. Remember that maybe the market is pricing in some risks associated, and we'll get to the risks at the end, but it's pricing in certain risks. Okay. So taking a look down here, no risk of bankruptcy according to the model. The model's liking this. The model's saying, hey, Best Buy looks good. Best Buy looks cheap, right? Put 5% of the portfolio. Don't do that, but like it's saying, put 5% of the portfolio into that. And then again, we're assigning the highest weightings to the decays, okay, to the decay factors. So we're assuming a pretty pessimistic outlook, and I'm not even giving them the full buyback. Let's assume, for example, 20%. Well, okay, at 20%, it no longer likes it. 20% says, oh, okay, that's a little bit too much that you're asking for, and the probabilities of you actually getting that are fairly low, so doesn't like it anymore. But at 50%, it does like it actually. All right, so let's take a look at the ratios to see what's been going on with this business. We're looking at the 5-year version. So liquidity looks pretty good for a business like this. This is not too much of a concern, the current ratio being just below 1 in 2022. Oh, just so everyone understands, you see this ROIC is actually sitting at 0%. This is because the full numbers aren't actually porting in. So pay attention more to 2021. And obviously we haven't finished 2022. So that's something for everyone to really think about, okay? So I'd pay more attention to the 2021 numbers than the 2022 numbers. And those are some hints that the model kind of gives me. That's like, oh, I'm not really like pouring in 2022's numbers yet. So let's look at 2021 and kind of go off of that. Of course, some of these things are porting in nicely, but others are not. Okay, so for various reasons, because we're not really technically done. All right, we're not done at all. But anyways, total debt ratio, they're improving the balance sheet. It got worse from the long-term debt to capital, but again, in some aspects, it is actually, what did I say? I was looking at the wrong dates. No, it's actually getting worse across the board, and they are actually increasing the financial leverage. Yeah, so not so good there, but interest coverage is pretty good because we're in a low interest rate environment. Gross profit margin pretty steady, slight decline. Operating margins, again, slight decline, high competition. That's what that's telling me right there. Boom. Net profit margins actually rising. Some efficiencies are probably being realized. ROA, ROE, pretty good, pretty good. Okay, and then ROIC is pretty good. Okay, so you see, I'd prefer to actually think about the ROIC is over here. Still a very good business. Management is executing very well. I like that. Let's take a look at the sentiment score. Sentiment score is, a little bit lower. We got some mentions here. Let's see. So any today is the 21st. So we got one there okay. So we got one today. Best Buy reframed 25 targets better with 4 points. Okay. So that's from Seeking Alpha. We got a couple articles on Seeking Alpha, dividend increase. So a lot of dividend investors take a look at these businesses or this business in particular. I know some of you are dividend investors, but yeah, overall, pretty good. Okay, we are expecting an estimate drop in revenues. Okay, and cash flows a rise. Cash flows are, ignore this, like quite literally ignore this. This is not actually zero, but we can see the trend line. The estimate's actually porting in, and then shares, it's cannibalizing itself very nicely. So if you believe in that story, you believe they're going to maintain themselves, Best Buy is a very interesting and compelling play going forward. So I think Best Buy is interesting. I do. I really do. So will I be adding to Best Buy? I'm going to think about it. I'm not going to lie. I'm going to think about it. It's not a business that I'm entirely too excited about. Not a business most people are excited about, but I mean, I'll discuss the risks now, and we'll segue into that. So, and this is probably what's keeping me away from it. It's the uncertainty of Best Buy in a growing e-commerce market. So, and again, the thing is, Best Buy could be a very good buy. It very much could be. And it's okay if I don't buy it, because you don't have to swing and buy everything. There are some businesses that are going to be great investments that I don't invest in. And I'm perfectly okay with that, right? I don't need to invest in every great opportunity in order to succeed in life, in order to profit and live a good life, right? All I need is just the ones that I like, and just a couple really good ones. Okay. But here are the risks. So I see Amazon, obviously the Amazon effect, as a big risk for something like Best Buy. I also see Target. Target's a big risk for Best Buy. I also see Walmart. Walmart's a big risk for Best Buy. Basically, all these big retail companies are big risks for Best Buy in their own capacity, right? And at the end of the day, they are congregations of goods, and those goods are really what I desire. I don't really care where I get them from. So the power actually lies in the scale of the merchant. And of course, the power for the consumer lies in the branding. I want a specific TV. I'm going to get it from wherever I can get it, the most convenient and the cheapest. For example, I've just purchased a bunch of monitors, right? And each of those monitors cost, well, depending on the deals, but I bought a monitor that was like a $400. One of them was $400, but I got it for $100 on Amazon. They were going through just a crazy flash sale that they gave me, and I got a nice discount for it. And it's brand new. It was a brand new monitor from the actual merchant, Asus. So it was really good. And then I also got a bundled deal for some other 1080p monitors on Amazon, right? I didn't see those with Best Buy. I always make sure. And then I didn't see it. They didn't give it to me. They didn't give me the price match in that instance, but I did like it because it was promotional. That's why it didn't price match. And if I go buy a TV, I'm going to go on the one that's the most convenient. I think that most consumers are the exact same way. There's not a same level of loyalty. Like, I don't have extreme loyalty for Amazon's e-commerce platform. It is just at the point where it's so convenient that I just go on an app and just buy it, and it's here the next day. They have the infrastructure for that. So in that capacity, they have my loyalty. But if Best Buy improved it tomorrow and they are even more convenient, I'd just go to Best Buy. Best Buy, in my opinion, competes for my business based on price alone. My wife, she loves Target, but that's a little bit different. Target's like its own thing. I don't understand Target. I really don't understand Target. But even some of my guy friends, it's not exclusive to girls, some of my guy friends are just in love with Target. It's like, it's a store. Like, comment down below if that's you. There's nothing wrong with that. Again, like, people, you know, dear to me and close to me are like that. So I'm not going to judge you if you are in love with Target. I just don't understand it. And then, you know, I think maybe there's some people out there who are, you know, in love with Walmart to that same degree. I don't know anyone who's in love with Best Buy to that degree, but there might be some out there. Just let me know. Actually, comment that down below if you are super loyal to your local store. And, you know, I don't know, but, you know, just let me know. All right. On that note, guys, I'll just say that this is not for me. I can see it there. The presumptions that we have to make aren't very high for us to actually kind of succeed in this investment. But the risks are there. They're definitely there. It's not a free of risk business. It's not a good looking business. It's not something with a high moat. It's not something with high barriers to entry. In fact, I question their ability to compete on scale, which is very important, right? Walmart definitely can compete on scale. Target has shown it can compete on scale and with this crazy branding, which is a side note. Best Buy, I don't see it competing on those fronts, but that doesn't mean that they can't execute, and the market might be mispricing it. Okay. I just won't personally participate. All right. On that note, guys, I hope you guys have a great one. If you guys enjoyed this video, feel free to leave a like, comment down below if you have any questions, concerns, or, you know, answering any of the questions I laid out before you in this video. If you guys aren't subscribed, go ahead and subscribe, and you can come back to the channel. Maybe I'm talking about a stock you're interested in, and, you know, I'll be sharing my perspective, of course. On that note, guys, I'll see you guys in the next one. Have a good one.